There is a moment that happens in almost every serious conversation about money. Someone says real estate. Someone else says the stock market. And then nobody actually does the math. They trade opinions. They trade anecdotes. They cite their cousin who bought 3 properties and retired at 42. They cite Warren Buffett. They talk for 20 minutes and leave more confused than when they started. So let's end that conversation today. Permanently. We are going to run the same $50,000 through both vehicles. Not a hypothetical, not a best-case scenario, not a YouTube thumbnail number. The full picture. Every cost, every tax angle, every hidden variable that people leave out because it doesn't make for a clean headline. And the conclusion is going to surprise you. Not because one side dominates, but because the real answer has nothing to do with which asset is better. It has everything to do with which version of you shows up to manage it. 2 people. Call them Mason and James. They are not fictional archetypes. They represent a decision that tens of millions of people face in their 30s when they've saved some money and have to choose what to do with it. Both have $50,000 saved. Both earn $60,000 a year. Both live in the same mid-sized city. Neither has any existing investments. They meet at a mutual friend's wedding, talk money over dinner, and make opposite decisions the following Monday morning. Mason buys a $250,000 rental property, a solid 2-bedroom in a neighborhood with strong rental demand. He puts his $50,000 down as a 20% deposit, takes a 30-year mortgage at 7%, and finds a tenant who pays $1,850 a month. Before he's even made his first payment, he feels like he's arrived. Tangible asset. Monthly income. A deed with his name on it. Real estate has been building family wealth for generations. His father owned property. His grandfather owned property. This feels right in a way that a brokerage account simply doesn't. James opens a total market index fund with his $50,000. He automates $400 a month in contributions. He reads 1 book on index investing, puts his phone down, and doesn't check the account for 6 weeks. His friends ask what he's doing with his savings. He says, index funds. They say nice, and move on. There is no story here. There is no key in his pocket. There is no asset he can drive past and point at. There is just a number, quietly growing in the background, with no drama attached to it. On day 1, the social score is not even close. Mason wins. By a mile, but we are not measuring social scores. We are measuring net worth at year 20. And the path to get there is where everything gets complicated. Let's build Mason's numbers from the ground up. And let's be completely honest about both sides. His gross rent is $1,850 per month, $22,200 per year. His mortgage payment, principal plus interest on a $200,000 loan at 7%, is $1,331 per month. On paper, that's $519 per month in surplus. $6,228 per year. Mason does the math on a napkin and feels like a genius. Now let's add reality. Property tax, 1.1% of value annually on a $250,000 home, $2,750 per year. Landlord insurance, approximately $1,400 per year. Routine maintenance, the standard professional estimate is 1% of property value annually, $2,500 per year. Vacancy, the national average for rental properties is 6 to 8% of the time, meaning roughly 3 to 4 weeks per year of zero income, approximately $1,600 in lost rent annually. And if Mason self-manages the property, he is working a part-time job without a salary. If he hires a manager at 9% of rent, that's $1,998 per year gone before he sees a cent. Let's say Mason self-manages to preserve the margin. His actual net operating income, rent minus vacancy, taxes, insurance, maintenance, is approximately $13,950 per year. After the $15,972 annual mortgage payment, his real cash flow in year 1 is negative. He is paying out of pocket to own this property. This is not a disaster. This is normal. Most rental properties in moderately priced markets are cash flow neutral or slightly negative in years 1 through 3 when purchased at market rate with a 7% mortgage. The returns come from equity accumulation and appreciation, not from the monthly check. And here is where Mason's investment gets genuinely powerful. U.S. residential real estate has appreciated at 3.8% per year in nominal terms over the last 30 years according to the Case-Shiller Index. At that rate, his $250,000 property reaches approximately $527,000 by year 20. His remaining mortgage balance after 20 years of payments on a 30-year loan is approximately $155,000. That means his equity, what he actually owns, is roughly $372,000. Add cumulative net cash flow over 20 years, which after all real costs is somewhere between $40,000 and $70,000 positive in a well-managed property with rising rents. And Mason's total wealth from this single investment is approximately $420,000 to $440,000. Mason put in $50,000. He controls a $250,000 asset. That is a 5-to-1 leverage ratio, and it is the single most powerful structural advantage real estate has over equities. When his $250,000 property appreciates at 3.8% annually, it gains $9,500 in year one. On his $50,000 investment, that is a 19% return from appreciation alone, before rent, before tax benefits, before mortgage paydown. No index fund gives you 19% on your invested capital just from market movement. This is why leverage is the reason real estate creates more first-generation millionaires than almost any other asset class. You are not just investing your money. You are investing the bank's money at the bank's risk and capturing all the upside yourself. The catch is that leverage is a multiplier, not a guarantee. When property values fall, they fall on the full $250,000. If his property drops 20%, Mason has lost $50,000, his entire down payment, on paper. The psychological and financial stress of being underwater on a leveraged asset is something no simulation fully captures. Leverage rewards patience and punishes panic, which, as it turns out, is exactly what the stock market does, just without the paperwork. James's investment has no story attached to it, and that is, paradoxically, its greatest strength. The S&P 500 has delivered an average annualized return of 10.5% over the last 50 years. The total U.S. stock market has returned approximately 10.3% annually over the same period. These are not projections or marketing numbers. They are published, verified, and reproducible from Federal Reserve economic data and Morningstar's historical records. Adjusted for inflation, the real return is approximately 7 to 7.5% per year. At 10% annually, James's $50,000 grows to $336,000 after 20 years without adding a single dollar. But he adds $400 per month. Those contributions, $96,000 total over 20 years, compound alongside his original investment. At a 10% average annual return, James's total portfolio at year 20 is approximately $580,000 to $620,000. At a more conservative 8%, he lands at approximately $420,000 to $460,000. He paid zero property tax. He received zero calls about broken appliances. He took on zero mortgage debt. He held a portfolio diversified across thousands of companies in dozens of countries, and he never had a single week where his entire investment depended on one tenant in one zip code. But here is what James does not have that Mason does. No leverage. His $50,000 controlled exactly $50,000 in assets. No depreciation deduction. Mason deducts approximately $9,000 per year in paper losses, a legal tax shelter James simply doesn't have access to. And no cash flow. His dividends yield approximately 1.5% annually, not a replacement income. Not even close. James's returns are real, consistent, and genuinely impressive. But he built them with a completely different set of tools. Every comparison like this has a version that makes real estate look incredible and a version that makes stocks look unstoppable. Both sides hide something. What the real estate side hides: transaction costs. Buying and selling Mason's $250,000 property costs $12,500 to $20,000 in commissions, legal fees, and transfer taxes. He needs 2 to 3 years of appreciation just to break even on entry and exit costs. No index fund charges you 6% to get in. Capital expenditures. Roofs cost $10,000 to $18,000 to replace. HVAC systems cost $6,000 to $12,000. These are not surprises. They are scheduled future expenses that most landlords fail to budget for until the bill arrives. Concentration risk. Mason's entire $50,000 is in one building, on one street, in one city. James holds fractional ownership in over 3,000 companies. His single worst holding cannot meaningfully damage his portfolio: bad tenants. A tenant who understands eviction law can legally remain in a property for 3 to 6 months after stopping payment. That is 3 to 6 months of zero rent, plus $3,000 to $10,000 in legal fees. What the stock market side hides: behavioral destruction. The S&P 500 returned 9.9% annually from 2000 to 2020. The average equity investor earned 4.2% over the same period, according to Dalbar. The gap, 5.7 percentage points per year, is caused by selling in panic and buying in euphoria. The asset performs. The investor does not. Crash psychology. In 2008, the S&P 500 fell 57%. In March 2020, it dropped 34% in 33 days. For James, watching $200,000 become $126,000 on a screen is not a theoretical exercise. It is a physical experience, no income. Index funds generate no meaningful cash flow before withdrawals begin. Real estate sends Mason a check every month. At year 20, Mason and James are standing in roughly the same place financially. Mason, property worth $527,000, equity of $372,000, cumulative cash flow and tax savings of $70,000. Total wealth, $420,000 to $440,000. James, portfolio worth $580,000 to $620,000 at 10% returns, or $420,000 to $460,000 at a conservative 8%. Fully liquid. No debt. Accessible in 48 hours. The raw numbers are close enough that declaring a winner on return alone would be dishonest. Mason's outcome depends heavily on factors outside his control: his local market, tenant quality, ability to fund capital expenses. One sustained vacancy, one structural repair, one bad local cycle, and the numbers shift meaningfully. James's outcome depends almost entirely on one factor: himself. Whether he holds through 2008, whether he holds through 2020, whether he holds through the next crash, the asset class is not the variable. The investor is the variable. In 2019, the Quarterly Journal of Economics published the most comprehensive long-run asset return study ever conducted. The rate of return on everything. Researchers analyzed returns across 16 developed economies over 145 years. Residential real estate, approximately 7.5% per year in real terms. Equities, approximately 7% per year in real terms. The difference across 145 years and 16 countries, less than half a percentage point per year. The gap between Mason and James at year 20 is not determined by real estate versus stocks. It is determined by whether Mason manages his property like a business or a hobby. It is determined by whether James holds through the next crash or panic sells at the bottom. The asset class is not the variable. The investor is the variable. What actually works, what the wealthiest people in every room already know, is owning both. Stocks for liquidity, diversification, and passive compounding. Real estate when the market, the rate environment, and your personal capacity make the leverage math genuinely favorable. Stocks give you scale without effort. Real estate gives you leverage without a margin call. Together, they cover most of the risk that either one carries alone. Mason and James both made a good decision that Monday morning. And they both made a mistake. Mason's mistake was thinking the asset would do the work. James's mistake was thinking the market would handle the psychology. Neither asset builds wealth by itself. Both require a version of you that shows up consistently, not just when markets are rising and tenants are paying, but in the years when nothing seems to be working and every instinct tells you to make a change. The real question is never stocks or real estate. The real question is, which one can you hold? Without flinching, without overthinking, without making a decision based on what the market did last Tuesday for the next 20 years. Answer that honestly. Then put the money there. And stop checking it. If this broke the debate down clearly for you, Share it with someone who is still stuck arguing about it. And tell me in the comments, Mason or James, which path are you actually on right now? I'll see you in the next one.